called bonus shares. I think most of the CNBCs also, most of the bigger companies would love to give bonus shares. In simple words, bonus shares is something like free shares given to the investors. Okay. Why it is done, we will understand with an example. Okay. It is is just told simple in like a stock split itself, 1:1, 2:1, 3:1. But definition wise, if you hold one share, I will give one share. If you hold one shares, I'll give it two shares. I will give two shares. It's free shares given from the company. In the stock split, the share what you have is broken. But here, the same face value is given back to you. So that's the power of a bonus share. Okay. So principally, this is how they just give bonus share of a company X is declaring a bonus of 1:1 for all the investors with so and so date. Now let's see the same understanding how why it is done and how it is done. Okay, let's say that I have 0.1 million shares with me as a company, and each share value when I started is $10, and the total share capital is always multiplied by these two figures, right? So it's 1 million now. And let's say that I've run the business for a couple of years and made decent money. Maybe I have made $2 million. Okay. Now I have two options: either give to the investors as a dividend, or give to the investors as a form of shares, that is bonus share. This is a simple math. I think it will be easier for you to guys understand. Number of shares before the bonus, it's 0.1 million, right? It's the same value. Okay. And the face value is also the same. And you see the share capital is the multiplied, right? This into the number of shares is the share capital. And the company is having around $2 million. Either I can give to the investor or I can give as a bonus share. Now see the magic how it turns to be here. When I declare a share of 1:1 as a bonus, someone has to give money, right, for that particular share. I have 0.1 million shares and I'm declaring 1:1 in sense after bonus there are 2 million shares. So there's 1 million shares which is coming, 0.1 million shares which is coming. Someone has to give money. So what company does? Company says, okay, I will give. It takes 0.1 million shares, creates it, multiply by this value, move the money from the reserves to the share capital. Okay? Understood? So now the share capital has 2 million because the number of shares have moved to 0.2 million after bonus. So I had 0.1 million shares. After bonus, it has become 0.2. And you see the magic here, the face value has not changed. Face values remain the same. In stock split, we are dividing the face value itself. One chunk of the bigger one is broken into smaller pieces. But here we are creating multiple pieces of the same value. Right? Now you guys have any questions on this both the things, like why it is done, how it is done. How it is done though I have explained like on structural level. You see the value before bonus, it is the same, it's 3 million. After bonus also is the same. So even before the bonus and after the bonus, the number of shares would be different, but the value will remain the same. The market cap of that particular company remains the same. The money is just moving from one account to the other account. That's it. And that's how they create shares. It's not like someone else is giving money, it's given from the company itself to the investors, right? So similarly, like how on stock split we see that decline in the price. Similarly, it is the same. Before the bonus, the share price would be $400, and after 1:1 bonus, it was half because the number of shares have doubled, right? You guys didn't understand this? You didn't understand?
Price becomes the stock price.
Yes, stock price becomes 200. Okay, let me help you understand. Market cap, you might be knowing, right? Market cap is number of shares I have today into the share value. Let's say that the total number of shares in the market is 100 and the share value of each is $400. The total market cap is $40,000. Okay. Now you say that we have given a shares, means the company has given more shares. So this component has changed to 200, right? And this multiplied should be 40,000, right? It can't change to 80,000. The market cap remains the same. It's just the number of shares are more because we have included more shares. So the market value is half of the price of that accordingly. And this is for 1:1. If it's for 1:2, the ratios will be different, right? That is how it is done. So even though some people will think, oh, company is given bonus share 400 rupees today, they'll give another 400 rupees. No, they don't give, right? They have to give a 200 and that will multiply, will be the investment. But if you stay long, means keep investing in that company for a longer term, yes, you can make money. That is the power of bonus shares as well. This is what I've done here. I've done an explanation where before bonus there are 100 shares. Then after bonus, the 100 more new shares have come and the price per shares are dropped down. And the total market value should be remain the same. That's how the maths is done on the bonus shares. You want me to explain bonus shares?
I don't change it because of me.
Okay, I'll do later for you then. Like.
Okay, yeah, no worries.
Okay, I think there's two terms like everyone has to know when this corporate actions are given. One is the X date and another is the record date. X date is something like, okay, let me explain first record date. Record date is something like company says we will see the ledger on that particular day saying that if who is eligible to give that particular corporate action. If I'm declaring a dividend and there are a lot of shares keep transferring between the people every day, right? And company are like, oh, it's very difficult for us to do that. So company says, okay, don't worry, we will just stick on with one day, that is called record date, and we will see who are the investors on that particular day, and we will give the bonus, or we'll give the dividend, or we'll give the stock split. That is called record date. So whenever you wanted to get any corporate action, like any time you wanted to get the bonus, anytime you want to get the stock split or dividend, you have to always check for the record date and the X date. X date would be usually T minus 2 or T minus 1 because the shares in every country takes around T plus 1 day to get transferred to your Demat account. So ideally, if the company says the record date is 25, you should basically have your shares within 24. Because record date, on that record date, in sense on the Demat, you should have your shares. Else you will not get the corporate action, whatever the company has declared for. So it's a very important date like the X date and the record date for all these corporate actions. Okay, I think this is I think most of them might be knowing the types of order. We have limit order, market order and stop loss order. Limit order is something like you are bargaining with someone saying that I want to buy a particular grocery at that particular price itself. I don't want to neither give higher neither lower, just that single price. Market price is like, okay, I'm just ready to buy at whatever price the other seller is giving to me. And stop loss could be something like, okay, I've invested 100 rupees and I have appetite to take risk of 4%, that is still 96. And below that, if something goes down, I really wanted to sell my shares. That is where the stop loss will help you out. In stop loss, you actually have two types: stop loss market order and stop loss limit order. In stop loss market order, it's.
I was just curious, like in the slide before you showed 3 ways to buy, like limit, market, or it doesn't matter. That's also for sell.
It's for the sell also.
Okay, and then the stop loss, is that?
For sell and buy both.
Okay.
So usually buyer will set up a stop loss, like he don't want to take a loss. So it is mainly done for the buyer.
So if I did a stop So like if I did stop loss for a buy, and let's say it's Bitcoin or something, right? And that's at 105K or something. What does that mean? Like if it's at 107 and I want to stop loss at 105, I'm like, oh, when it comes to 105, it's like get me in.
Okay.
What else would happen? What's the loss portion? Why is that different from the limit order?
No. So I'll help you understand how this works. For example, you have invested $100, okay, and you say that I really okay to take a risk if it's only 5%. That is until 95. And you say that if the stock price goes below 95, I just want to exit. I just want my money to be safe. That is where the stop loss orders comes into the play. It is basically for buyer who is saying that, okay, I am not ready to take a downfall of that particular stock.
Oh, okay.
I just want to exit. I don't want to see.
For something you already own.
Yes.
Oh, okay. It's not an order.
Even for the traders do that. Intraday traders also do have the stop loss order.
This is the first two, limit and market?
Yes.
Or the same
So
order?
limit orders is, as I said, like you're saying that 100 rupees, you have 100 rupees, and you wanted.
Because for the active purchase, right?
Yes, accurate purchase. There's nothing like.
Active, like it's for the. So, can I put a stop loss on something I don't own? I have to own it already. I have to already own the stock and say.
Yes, yes.
I have a risk appetite of only 5%, whatever.
Yes, you have to
right?
own it. Yes, else you can't do
So
that,
it's
no.
not like a purchase.
Yes,
related.
you have to purchase. Then only you can place this order, stop loss order. This is something like I have 100 rupees. I can only give you 100 rupees. I'll not give you neither 99. I can't give you 101 also. 100 is my buy price. You want, you give, or else you don't give. It gets executed, not executed. Market order is something like, okay, I'm ready to give 101 also, 100 also, 99 also. Whoever is the first seller, I'll give and just purchase, exit the execution, done with the execution. But the stop loss market order is quite tricky here. Let's say that you have bought at 100 and you say that stop loss market, there's something called stop loss market order, and you set up a trigger saying that I am ready to take only 1% loss, and if the share value comes down from 100 to 99, whatever, it is a trigger point. It's like if the share is coming from 100 to 99, it just sells. It doesn't care whether the price of this particular share has moved to 99.5 or it has come down by 0.5 rupees less. It doesn't care. It just sells immediately. That's the reason called stop loss market order. It doesn't do anything here. It just sells it. So some investors, like they are very specific in while selling also. They say we need that price while selling. So that is where the stop loss limit orders come into the plane. Okay, now see the game. I have 100 rupees. I've invested for 100 rupees, and I say, okay, if the stop loss limit order, I would have put a trigger at 92, exact 92, and see the game what it happens. Let's take an example. I put at 90. The stock has come down from 100 to 95, and from 95 it has come to 92.1, but within fraction of time it has just moved to 91.1. Just because you place an order at 92 stop loss limit order, until you find a buyer at 92, your order is not executed. You're basically saying, I want to sell this particular share at that price itself. But in market order, if that order is triggered, anyone less or more, it will be immediately settled. See, 100 is the share value, got down by 90, got down to 99. The system is triggered. Like anyone after this particular point, you just sell the share. So first cases, the share could have gone up immediately after a second. The share is sold to this man. If the share has come down from 99 to 98.5, it is sold. This is just like a trigger point to him. So that's the reason it's called stop loss market order. Just sell it after that particular trigger point. In this, you are basically saying, I want 92. I don't want to get compromised. I don't want 91.9 also. I don't want 92.2 also. But the chances is if the market suddenly goes from 92.1 to 91.91, where is 92? The chances could be less, right? You could have not bought there might be another buyer who is buying at 92. There you miss the execution, and the loss can go down.
Set multiple?
Sorry?
Stop loss limit orders?
Sorry.
Can you set multiple stop loss limit orders?
Like, for example, you can set at 100.
One is triggering at
And if you trigger for the down one, if it's triggered, it just goes, right? You can put it for different quantities. If you have 100 quantity, and if the stock, and you want to say that, okay, I just want to liquidate if the market is down by 5%, my 50% I just wanted to sell it. So you can place the other 50 quantity at this price, another 25 quantity at this price, another 25 at this price.
or you could do all of them. And if it, like you said, the danger with this one is it gaps so fast that your limit is not met.
Right.
So just set the next one lower.
Right.
That you're okay with. Like something's gonna capture.
But other than that, that could be better, no? Market orders are better. Either it goes up or down.
Because I think the flaw in this one is if there's not liquidity,
Uh-huh.
then
Yeah.
market could be like, hey, we're
Right.
$2 for something that's worth 100.
Right.
So you just try to cover your bases. And just
Right.
say, okay, 92, 91, 90. I don't know. If it's just a computer program, just tell it to do all of them.
Makes sense, yeah. Works.
I was just wondering if it could be done. Okay.
I hope this difference everyone has done, because you guys will be able to see in on the broker's account what this type of transactions are done. And there's something called a circuit breaker or circuit filters. All the companies on the indexes, it will not just allow you to take a run every day by 20% or 30%. They do have upper and lower circuits. Like a small cap can maximum go up 5% or 6% in a day, because it can be manipulated. So the regulatory says that if it's a small cap, not more than 5% in a single day, a single rally, or or the stock going down. Even for the bigger companies, it could be 20%. After 20%, you guys have to wait for tomorrow's market scenario, what is happening again. It just doesn't allow you to keep growing in a single day, because to keep the retail investors safe. That is why circuit filters are done. This I've given a brief because I want to do the technical analysis as well. But in simple words, if you see the higher highs, this is called an uptrend. And if you see the support and the resistance are towards the same line, that's called sideways market. So in CNBC's channels, they say that today it's an uptrend market. They say basically because the higher highs are going upper, and that's an uptrend. And if lower lows are happening or lower highs are happening, it's a downtrend. And there's something called as block deal. This we will be mostly sticking for fundamental analysis. If more bigger quantity of shares are transacted in the market by FII or DII, it could be a good sign or a bad sign. But when we analyze a company, yes, this also one factor we have to check. Any companies are buying or selling. It will be given a good perspective whether to buy that company and hold it for longer term. If FIIs are buying bigger chunk of shares of that particular company, it is a good sign, right? Like if Singapore government is buying Tesla, every retailer would like, oh, Singapore government itself buying only, why can't I buy? It's a good sign. And there's something called as bid-ask spread. I think everyone would be knowing what is this bid-ask spread. If someone is ready to buy at 100 and someone is ready to sell at 101, so there's a difference, right? The buy and sell price. This is called the bid-offer spread, where until both the parties come to a place for the transaction, it will not happen. That's where the market makers comes and play the game and make their money. I hope everyone is able to understand this particular concept. And the common mistakes most of them do is penny stocks. How it is getting manipulated. This is called ring trading. Basically, there are few people with a larger chunk of money. What they do is they buy one stock at $10, then they sell it to his friend only who has larger money at $12. Then he sells to another friend at $14, and he sells to another friend at $16. Then he sees that okay, there's a good number of retailers who are waiting for this particular stock. They try to push everything to these retailers and they exit, and all the shares, all the profit would be distributed to these 5 people. So that's the reason people ask us to invest in penny stocks, because the other party or the bigger people will be making money there. Why not to invest in penny stocks? It's easier to manipulate because the market size is smaller, and they 500 million or 600 million would be easier to manipulate this particular stocks. So for retailers, it's always should avoid penny stocks until you really know that something good will happen to that particular company. And over trading is, I don't suggest like people to over trade in equity markets, neither in F&O. And always checking the stocks. This is a baddest habit. Like you will just go crazy. Like if you keep checking the prices of the share, right? I think if you are a long-term investor, invest in the right business and stick and just hold for long term. So that's what I believe. Yeah. So this is my LinkedIn and Twitter ID. Like if you guys really want to understand more on stocks and how things work, you guys can follow me. Apart from that, any questions I am here to answer. I hope everyone is able to understand and got something new today, right? Yeah. Thank you. Yeah, please tell me.
Yeah, as a company, I mean, why they want to differentiate between bonus and stocks? I mean, why they want to do it in the two different?
Okay.
I know it's in terms of the face value. So
Right.
does that matter for?
No. So what happens is, in stock split, actually you are not really worried about the company's financials. It's only the stock price, right? You're basically taking a chunk of cake, a big cake, and cutting them into small pieces.
Yeah.
You don't need money for that. But for the bonus shares, you need money. See, when I say bonus shares, you need these reserves. Reserves is the profits the company make, right? So bonus shares are declared only when the company has made a lot of profits. So the money has to go from the reserves to the capital account. But in the stock split, you need not have the money. You just have the face value and you just divide them. You just divide them. Because there's no money needed to do this process. You take this chunk, divide into 4, take the older share, give the new shares of 4. Similarly happens here. In this process, why they do, when the price of the stock is so high and most of the people are not able to do that, they try to do this stock split. Very rarely reverse stock split happens, but this is not needed. But yeah, most of the time if the prices have reached their maximum or they
When you do like a signing bonus for a company, they're like, we'll give you 5,000 shares to sign, and they do a split, your shares are worth less. Right? Like they only give you 5,000 shares, and they've halved your bonus.
Well, you have 10,000.
When you sign for a company in like Silicon Valley, and they're like, we will signing bonus, we'll give you these shares. Okay, so once you get them, if they do a split, it's fine.
yes.
But if you get them later before a split,
Yes, that matters, no? Because the face value would have been
I wonder if
reduced.
This trick comes into play.
Yeah, definitely, no? That is how the companies all play their game.
Like if it's a promise of a share in the future, the other company would obviously be like, assuming there's no split, it has to happen before you split.
Again, it all depends. Today, as I mentioned, in US market, it can be 0.1 cent as a face value. But India, it is multiple of 1 rupee, right? You can keep giving the split. Tomorrow, the share value, let's say the share value of Apple has reached 500, and they can give a split of 1:1. They can make it half by increasing the number of shares. In simple words, splitting the shares itself. You're taking a single share and making it half. That is what stock split is. You don't need money to do that.
So if the stock price is 1 rupee, you can't split it.
In India, you can't.
Yes.
Yes. In India, you can't. But in US, you can do that. But in bonus, the magic is, so you can do that until you don't have this money, because you are giving free shares to the investors. Free shares in sense, you need money to get that free shares, right? So that is where the reserves come into the plane, and they should have that particular amount to give the share, give the bonus to the investors. If they don't have money, how will the 0.1 million shares comes here? They can't do that. Correct, no? I can't just keep adding the share capital there, because you need money. You have to really move the money.
And there's no room for corruption in this kind of stuff, guys. Everything's by the book. Especially-
I hope it answered your question, right? Like,
Yeah.
you want me to explain more clear? I can do that. You want me to do that?
But this money they can borrow from someone.
Usually they don't do that, because it is on the net profit. Net profit only. This it goes to the shares, reserves and surplus.
Oh, if they borrow, then will be the
Borrow also.
placement.
Yeah, it would be debt, no? That you'll understand in fundamental analysis. Debt money, you will have the account of, there's something called as debt to equity ratio. So you keep checking whether the company has more debt or less debt than their equity. So that is also a good question. If they're able to, if they're raising money and giving bonus, it's a bad sign.
Yeah.
They have to give from their reserves. That means the real profits. That's the game. Any questions here? But yeah, it's a good question. But I hope it answered you, right? What is this bonuses? Bonus is basically, as a company, I need to put the money. I'm giving because I don't want to give as a dividend. That's the reason I'm giving. Either I could have given the 1 million as a dividend to the investors and would have not done this process at all. I'm like, no, I want to increase the number of shares. I think there's chances that more people will come and buy. That's the reason they could have done this process and move that particular money into the share capital account.
How about warrant? If they are giving bonus warrant.
Sorry?
Warrant. If they are giving out bonus warrant. Yeah, some company are giving out warrant, right?
Warrant in sense?
WARRANT. There's another type of shares.
Uh-huh.
Yeah.
So just help me understand the question. Like you are saying companies will,
Some they are giving bonus share.
yes,
Some they are giving bonus warrant.
bonus as a dividend, no?
Yeah.
So dividend also can be one kind of bonus to the investors. But they don't say it's a bonus, they say a dividend. But when they give shares, they say as bonus shares. And when they do stock split, they say as a stock split. And for that, they need not have reserves in their money. But for this, you need to have money to do that process, because you're basically saying, I am buying this another 0.1 millions of share with that particular value. You need to have 1 million value in your reserves in order to create another 1 million shares. That is like you're putting that another 1 million on your cap table. Then only it becomes 2 millions, right? So that is how it is. It's like a cap table game. You can say this bonus share is on cap table game. But usually bonus, if companies are giving, it's a good sign. I hope it answered your question, right? Okay. I really appreciate everyone. Thanks for coming. Any questions? I am here always. Thank you. You have any? Thank you. You want to understand anything more? You have any questions?
What's your